Thank you for joining us on the CEO Barbecue. My name is Antonio, and today I'm going to the Western United States and specifically Utah and Idaho to look for gold. Joining me on the barbecue today is Hugh Agro, the CEO of Revival Gold. Now, before I've warned you that we have received no monetary compensation for the production of this video from the company that's being interviewed, but you should still understand that this channel is a business that sells content producing services to companies, which means that they might pay us in the future. And it also means you cannot rely on this video for research, and you should treat this as advertisement, not as research. Research is conducted by reading the company's official filings, which you can find on setterplus.ca. Also, please only watch this if you know what you're doing. This interview is intended only for experienced junior mining speculators because mineral exploration, development, and mining is a very tough business where failure is the norm. This is going to be a conversation that is general and impersonal in nature, containing forward-looking statements. I am not a licensed financial advisor, so before continuing on, please talk to an investment advisor with a good long-term track record because your capital is at risk, and I am neither a licensed financial advisor nor do I have a good long-term track record to begin with. If you're not 100% sure you understand 100% of what was just said and written on your screen, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That was said, Revival is listed as RVG on the TSX Ventures Exchange, where an average of about 115,000 shares trade daily. Their 52-week high is 45 cents and their 52-week low is 24 cents. With a market cap of about 47 million Canadian dollars and about 200 million shares outstanding. Today, this is a 24-cent stock. So it's right there at that 52-week low. It is actually at an all-time low, and that's hopefully something we can talk about in the conversation. The number of fully diluted shares here is 240 million, though, meaning there are roughly 43 million options, won't call it dilutive securities outstanding, if you will, meaning an increase of almost 22% in shares outstanding can be expected if those options and warrants get exercised, which would then also result in about an 18% ownership dilution if, and that's always a big if those get exercised. About half of the company, or 44% to be specific, is held by institutions. 21% is estimated to be in the hands of high net worth individuals, and 15% in the hands of management and insiders, leaving only about a fifth, or call it 20%, in the hands of retail investors. The effective date on the last officially filed financial statement is September 30, when the company had $3.8 million in current assets. $3 million at the time was recorded as cash and cash equivalents, with some prepaid expenses and amounts receivable on top of that as well. But there have been no financings since, to my knowledge, so that treasury is likely lower than that today. On the other side of the September balance sheet, I see $1.6 million in current liabilities in the form of account payables, and I don't see any long-term debt. The 3 months that ended on September 30 this year had just over $1.5 million recorded as operating expenses, although that includes a small portion of share-based payments as well. The G&A in particular came in at about $500,000, which averaged out over that 3-month period comes up to about $165,000 a month. It is note 14 in the financial statement that tells us exactly what's in that cost, and the largest chunk is salaries, director fees, and consulting combined, and together sitting at about 35% of the overall cost, with investor relations coming in second at about 28% of the overall cost. As to the exploration and evaluation expense, there was a significant drop between the 3-month period that I'm talking about and the same 3-month period in 2023, which will hopefully become clear later on in the conversation. But the total expense was just shy of $1 million. This case, it is note 12 giving us the breakdown, and I see that the largest chunk was drilling, geology, and site costs together, which represented about 35% of the total cost, with technical studies coming in second at 23% and property cost coming in third at about 12%. As always, I've got two ratios for you here. First of all, the overall exploration to administration ratio, which currently sits at a roughly estimated 2-to-1, meaning about 34% of all the money spent here went toward keeping the lights on over the last 3 months. and so call it 66% went toward exploration. And that second ratio is typically simply the drilling to marketing ratio, but it's a little bit more complicated here because those costs are kind of lumped together, if you will, with the geology and site costs. So it is geology, drilling, and site costs to marketing that I'm looking at here. And that ratio was 2.4 to 1, meaning there's 2.4 times as much money going toward drilling, geology, and site costs than it goes toward marketing. Quick reminder, though, I'm not infallible, so I might be making mistakes in my reading and or interpretation of these numbers. And this is just one quarter of data. It's a past quarter too that we're talking about, so it's not necessarily representative of what's going to happen here in the future. So go to setterplus.ca for yourself and make sure you're getting the full picture. Look for the full for an up-to-date report or the full year financials by the time you're watching or listening to this. And talking about the full pictures for Revival, that full picture is fully focused on the United States, specifically, as I mentioned, Western United States, Utah. There's a little bit of a split now between Utah and Idaho, but potentially more attention onto Utah or not. Hopefully something I'll figure out later on in the conversation. Again, we'll talk about the assets more in depth in the second part of the conversation. But in a nutshell, between the two, there are 6.2 million ounces of gold, with about 60% of that resource being in the M&I category of the NI 43-101. So about 40% is still inferred. Of course, many nuances to get into here. And again, hopefully all things that we can touch upon later. But Hugh, this is your first time on the barbecue. So first of all, thank you for being here. But we'll have to start with you personally before we can talk about the company. Who are you and why would I trust you with my money?
Thanks for having me, Antonio. Really good to be with your audience here. I'm a mining engineer by background. I've been in the industry for about 35 years now. Worked with some of the majors, more recently with Placer Dome and with Kinross Gold. Was part of taking Kinross from a 1.7 billion market cap to a $17 billion market cap. When I retired from the industry in 2010, late 2010, I did so, took my marbles off the table and started a cycling career late in life. But I'll tell you what, this is a really interesting business. And by the time 2017 had rolled around, it was obvious to me that there was a big gap opening up between the pace of global discovery, let alone permitting and construction of new gold projects, to feed that growing need for new projects to feed the pace of global production. So I and some others put together Revival Gold, founding that company in its current form in 2017. And here we are now, about 7 years later, with two projects in the Western United States, 6.2 million ounces of gold, economics on the one project and a PFS now completed, and the second project at a PEA stage, expected by the end of the first quarter here. So that's a little bit about me, and happy to be with you for this chat.
And I'm looking forward to talking about the nuances on those two projects later on in the conversation. Insider ownership, again, noted at about 15% here. I believe the company started in 2010 is when you were when you got involved in at first, but it was, or you were appointed as a director in 2010. Nothing really happened, or not much in the line of what's happening right now happened up until 2017. So things have moved around. How much of that 15% insider ownership is you personally or your related parties, and what is the average cost of your shares?
I'm about a third, and my average cost is about all in is about 60 cents Canadian per share.
That so there's, I mean, what I'm checking for here is founder shares. You know, half a penny or a tenth of a penny founder shares. Did you have
No,
those? Is
no, no,
that
no, no,
included?
no, no. So you referenced the background to the company. As these venture companies work, I had come in as an investor to back a team putting together some phosphate assets in a shell back in 2010, and then in 2017 stepped back in to use that shell to create the Revival Gold. But along the way, I bought shares in every private placement, every public offering of stock, and in the market up to as high as over $1 a share. in Revival Gold. And so my average cost is about 60 cents a share. And I'm just under about a third of that 15%. And it's interesting. Over the last, I'm going to say over the last 3 or 4 years, uh, that interest by insiders has only grown from about 10% now up to about 15%. Even while we've brought in assets and continue to grow the business with new investment and new shareholders.
Hmm. What you're down 60%. Well, you're 24 cents, 60 cents, that'll be 60%. With your share price also at pretty much an all-time low right now, is that not a point in the market where you want to go and average down? I mean, are you expecting to be in the open market, both supporting the share price, but also increasing your position and your skin in the game?
Yeah, and we have been doing some of that. You'll see in the insider reports we've been buying shares. Insiders have been buying shares this over the last year as the share price came off in this tough market. And we'll certainly be buying more shares. Currently, we're blacked out as insiders. There's a few things going on in the company which blacks us out from trading, but absolutely, we're committed to what we're doing. We believe in what we're doing. We continue to surface value in the company. It's a very tough market, and folks like me who put their life and their full weight behind a business like Revival Gold suffer quite a lot of ups and downs. But we know that the rewards are there. If we create assets that will deliver value in the cycle, we will be rewarded. And the amazing thing is that when the cycle turns, it turns so quickly that if you're not positioned, if you have not been prepared to go through some of those tough periods for long periods of time, you won't get the rewards. And so we're in for the long term. We've been building this business over the last 7.5 years, and look, we think we've got a tiger by the tail here. So we will be buying more shares as insiders in the company when we're able to do so.
Why I'm asking this and why I'm mentioning skin in the game, Hugh, is because I'm wondering how incentivized you are, where your incentives really lie. Looking through some of the other roles and ventures that you've been involved with and you are involved with, as far as I understand, I can see a couple of mining stuff. I can see a couple of non-mining stuff that you've also been involved with before publicly. I'm trying to understand how important the investment in Revival is for you personally. So maybe you can talk to me about in percentages, what percentage of your portfolio would you say is invested in Revival, and what percentage of your time do you spend on running it?
Yeah, I probably spend 120% of my time on Revival Gold.
You don't
It's
sleep?
not just about the investment. For people like me who work in the mining industry, creating these companies and delivering for investors, communities, employees, this is our lifeblood, and so this is my number one focus. It is my passion. I'm really excited about what we're creating, the difference we're making in the communities in which we're working, and the potential for value creation. If you think about this business, we've got about $17 billion worth of gold in the ground. We're going to have to get that gold out of the ground, but the first step is to actually put the land position together, then do the drilling that actually discovers the gold, and then put the economics around that, which is a really, really interesting process in and of itself. It's very iterative. There are multiple factors that come into developing a winning mining project. And so we go through that exercise, of course, permitting, the preparations around that, the community side of it. This is my sweet spot. This is what I like to do. I've done it successfully in the past, and we're going to do it again with Revival Gold. So it is my 100% focus.
Hmm. Well, in those ounces, of course, only being worth something if you can pull them out of the ground, and if you can pull them out of the ground profitably, which is something, again, we'll cover in the second part of the conversation. But so how important is this investment to you personally? Like, is this one of your biggest investments? Is it, and again, I'm talking about just financial incentive here.
Yeah, it is my biggest investment, and it is my most important investment. and is the one I feel most excited about. You know, we it's very difficult to put these things together, and it's something that you can only do if you're able to weather the storms. And fortunately, I've made enough money in my career that I'm able to weather the storm here. But I think we're going to make a lot of money for our investors and for ourselves, and you know that's part of the joy. The real joy is in watching people's faces as you open up careers for them, and as you create opportunity for the community, and listen, making money for investors. That's what we really like to do.
Do you, and I think that's going to be the last part of my smell test questions. Do you or any of your related parties own a royalty on any of the projects personally?
No, absolutely not. And there are no extra benefits that come out of our involvement in this company. We are perfectly aligned with our investors. You spoke about seed shares. There are no seed shares in this business. You spoke about skin in the game. We have skin in the game. You spoke about commitment. We have commitment, and we've demonstrated that time and time again. I could go through each one of our directors and each one of our key members of staff in that regard, and we are perfectly aligned in that. Just on the subject of governance, which you haven't asked me about yet, we do have an independent chair. And so that's somebody that came in a couple of years ago, another gentleman with a successful past in the United States, taking brownfields assets through into production, a gentleman by the name of Tim Warman, and someone who's been very successful in the exploration game in the past as well. So we've got our one of our directors, Wayne Hubert, who was involved in founding Andean Resources, took that business from $100 million market cap to its sale to Goldcorp for $3 billion. Wayne is also the former finance director for Meridian Gold, which developed the Bear Track operation, one of our mines, and so has intimate familiarity with that. He lives in Salt Lake City, where we operate our Mercur project, just about an hour outside of town. We've got some of the best people on our team. Larry Radford, former COO of Hecla Mining, an Idaho native, and a mining engineer, a former colleague of mine from Kinross Gold, has operated open pit mill operations, heap leach, underground, just an outstanding technical profession. Norm Pitchard, who is the former COO and president of Eldorado Gold. You can see the common theme here. We have very strong technical team, and we have people on our board and management who don't need to spend their life grinding away in a tough junior market. We're doing it because we think we're building a great business, and that's going to be of great benefit to our communities, our employees, and of course our shareholders. So we're looking for another big win here.
Well, on the topic of governance, what is your stock options plan? I mean, I saw that last year, or like, how do you define that? I suppose the board gets involved here too. But so last year there was a grant of options. There's also cash payments involved with the board. Clearly not based on stock price performance. What is that? What is that based on?
Yeah, so we have first of all, we have an option program. I would call it one of the more conservative option programs in the space. These are 5-year options. We price well above market when we issue options to members of our team. And I think if anybody dives into the details, they'll find that we're very, very responsible in terms of shareholder-friendly option requirements. Yes, we also have a short-term incentive program for members of the key leadership team. This is critical to keeping good people engaged and on our projects. We've got some of the best in the industry. Our VP Engineering and Development did all of the development work behind the Stibnite project in Idaho, all of the engineering, the optimization around that 20,000 ton per day mine plan, and the permitting preparations for that, and then came over to join us to do that on Bear Track Arnett. An outstanding professional, a Barrick exec by background. Our chief geologist Dan Pace, is a co-discoverer of the Silicon deposit in Nevada, which is Anglo's biggest project there, a multi-million ounce gold project. And he too joined us a couple of years ago to be part of our geology team, and has now stepped up to take leadership of exploration as our VP exploration retired. This is a guy who lives and breathes exploration discovery, and is a key part of our team. And then I'll just mention our CFO, Lisa Ross, who is a former colleague of mine from Kinross Gold, worked in the trenches in the finance group there, and then went on to be part of Tony McCooch's group at the Kirkland Lake Gold, and was part of that roll-up, that business growth. Again, somebody with a lot of experience, putting things together, doing the M&A, doing the financial reporting that's crucial to building a business like ours. So we've got some great people. We've got to pay them to keep them. And that's what our short-term incentive plan does. As we get success across the various different metrics that that are important to our business, discovery of gold, relationships with majors, building out our government side, building out the engineering, and funding the business, and ultimately delivering value for shareholders. We would like to see our payments to our key people be even higher, and objectives are much higher, of course, but that's dependent on seeing the share price move as well. And so that's the next and most crucial step as we continue to develop out the business. First step, progress with the technical programs, with the asset, putting NAV onto record, and from that, of course, we'll see a share appreciation.
Actually, a good point to note here is that Lisa Ross, your CFO and corporate secretary, as well as your John Mayer, VP of Engineering and Development, and Steve, your VP of Exploration, they make almost as much money as you do. Actually, John Mayer, your VP of Engineering, he makes more money. His salary is higher than your salary is. I think his total compensation is also higher than yours. That's actually just an interesting thing to note on. I typically see it being the other way around. Obviously, CEO making the most money, and then people below him, always a step lower, and then the CFO, and so on and so forth. So that's an interesting note that I found in your management information circular. And while we are on that topic, change of control fees. Is that part of your incentive? How incentivized are you to seek a change of control here?
The way I look at it is first and foremost from a shareholder point of view. So we are very active on corporate development. There's a lot going on in the space. We've looked at a lot of assets for potential purchase. We've looked at a lot of scenarios for potential mergers of equals, and we've looked at opportunities to sell ourselves or do joint ventures on select assets. And I guess what I would say is the devil's really in the details. We landed on something last year which we think is an exceptional fit. We bought an asset in Utah, which is very complementary to what we have in Idaho. We did that at a very good price. And we brought in a few other key aspects around that, including shareholders, and including some synergies around our team and what their skill sets are. So there's a lot of different details to look at on the M&A front, but we are very active on that front. And the way I put it, Antonio, is that I can lead, I can follow, or I can get out of the way. What we're trying to do is create a great gold investment for our shareholders, first and foremost. And we can do that in any number of different ways. Yes, we have changes of control. This is not unusual for folks who are in the speculative end of the business. We cannot hold good people without giving them some ability to walk away from an M&A situation, to be highly motivated to deliver value for our investors, no matter how that impacts the person. So yes, we have changes of control, but I think you'll find relative to our peers that these are some of the most conservative out there. We have basically a 1-year base salary change of control. And that is, I think, shareholder friendly, responsible to our employees and key people, and something that doesn't limit our options for the future.
That's a good answer. What I'm that and it's a necessary question that I almost forgot to ask you actually. But when your share price is here where it is right now again, and you're at that part of the Lassonde curve, shareholders don't want you to get taken out because even if it's 100% premium, it really just brings you back to the price of like a year ago or something like that. And we've seen that happen well last year actually at this point. So what is your goal? What do you want to see happen here? At what point do you want to see these things being taken out? Do you want to see them being taken out? Do you want to build them and use them as mill feed for some of your neighbors? Do you want to build a mill? What's your overall corporate strategy here or corporate dreams and goals?
Well, I'll start by telling you what my wife's target is for us. She'd like to see us at $3 a share. She says, "Why the hell are you doing all this work when you could be paid a lot more money with a big company going back, to one of your past lives? To make that worthwhile for us, we've got to see $3 a share." So I've got that bullseye on my wall as I try to keep my spouse happy with what we're doing here. But the journey to get there, I think, and what makes Revival Gold unique is really spelled out in our name, Revival. We're the revival of assets. So we have focused on brownfield sites in good jurisdictions where we have supportive communities and where gold has been successfully produced in the past. Number two, we're about the revival of a team. This is a team, and I mentioned some of the backgrounds of the individuals involved who have delivered substantial wealth for shareholders in the past. And in my case, taking Kinross Gold as an executive leader member of that team from 1.7 billion to 17 billion in the last cycle. And what I can tell you is it's a lot of hard work. You got to put the effort in, and nobody sees it at the beginning. But if you tick the boxes and continue to progress things, you will be rewarded. So the third part of the revival at Revival Gold is in the gold price. And we have seen that in spades. We've called that market perfectly. When we started this business, it was about $1,000 an ounce gold. Here we are almost at 3 times that level. So then let's go back to strategy a little bit. Having discovered gold at a finding cost of $6 an ounce in the ground, here we are today getting about that value in our stock price. So there is no reason for us to continue to go out and add more gold to our portfolio. We've already got a lot of gold. I mentioned earlier, plus or minus $17 billion worth of gold in the ground. Spending money on drilling right now is not going to get rewarded in this market. And you can compare us to all of our peers. I'll tell you, we are at a 52-week low, but overall, we've issued less shares and delivered more value than many, many, many of our peers. And it's just a tough market. There's this bifurcation in the market. And what that says to me is that as part of our strategy, we need to focus on projects that we, as a smaller company, can advance credibly without having to wait for a big gold company to come and buy us. And so that's what we've done. We've borrowed a page from the Australian model of focusing on projects where for a small amount of capital, we can move into production. And then with the scale of these deposits that we've assembled in our portfolio, we can continue to build scale in production as well. And so, for example, at Bear Track Garnet, we've got existing infrastructure at our project in Idaho there. It's a big plus in terms of our permitting timelines. It's a big plus in terms of our risk in redevelopment because we know how the project and the site will perform. And so we've designed our PFS, our preliminary feasibility study, and our first phase restart plans around a modest $110 million of initial capital to restart that operation for 65,000 ounces a year of gold production. From there, we can go underground and we'll develop out the bigger potential in that 4.6 million ounce deposit. I see the potential there to go to 250, maybe even 300,000 ounces a year from our Bear Track Garnet project, but we're not going to come to the market with a theme of $500 million or more of capital when we've got this opportunity to phase it and be more responsible to our investors. That's Bear Track Garnet in Idaho. At our project in Utah at Mercur, again, brownfield sites, proven past production, some 3 million ounces of gold produced from this site in the past. And what makes this site unique is that it's a Carlin type deposit. These are the big deposits that have produced prolifically in Nevada. And we've got 1.6 million ounces of resource there. We're working right now, which we acquired. So we acquired it at a pretty similar cost to what it cost us to discover ounces of gold. A bit more, but a bit more advanced also in the property stage. And we were able to put this together. We're remodeling the geology. We're working on just the ounces that will make money for us in a first phase approach from heap leach. And we're working on getting the preliminary economic assessment out for that project. What makes that project unique and so complementary to our first project is that it's on private ground. And in the United States, from a permitting perspective, it's much simpler and straightforward to go through permitting on private ground than it is to do so on federally managed grounds. So that's the complementary fit for us with our Mercur project in Utah. And you brought this up earlier, but it is the one that's we think is first in line for production. We think we're going to be at plus or minus 80,000 ounces a year of production from that project. The combined production from our two relatively low capex first phases in these projects is 150,000 ounces a year. And again, going back to Revival Gold's strategy, our strategy and our approach is to deliver growth in gold for the benefit of our communities, for the benefit of our owners, and for the benefit of our team. And we do that in a fashion that is relatively low risk by pursuing brownfield sites and where we can have modest capital in a phased approach to build our portfolio and our free cash flow potential.
You bring up a good point about federal land versus private land, because I believe part of your package is federal land, and that's where you believe there's exploration upside. So we'll talk about that when it comes on to Utah. And then we'll talk about Idaho as well, because there's also a couple of questions about the deeper mineralization and specifically the metallurgy around it. But let's maybe start off with Utah, because this is a new asset for you. And my question here is, well, I have a couple of questions. First one is really twofold. I'll start with the first part. Why did you buy a new asset instead of focusing on Idaho? It was PFS. Why not look for a financing partner, go to FID, build it? Why did you have to go for Utah?
Yeah, so a few reasons. And we don't do anything lightly. This is after a lot of work on a lot of different projects, but this was a pretty unique opportunity. It was an asset similar, formed and assembled in a similar fashion to the strategy that we undertook with Bear-Track Arnett. The former Barrick Gold North American exploration vice president assembled this land position around the former producing Mercur mine in this Carlin type deposit. So this was a real geoscientist doing real land work, assembling a land position. Our mutual associate, Wayne Hubert, joined in the effort, brought in the Barrick piece, the Mercur mine, the past producing Mercur mine, and then also the Homestake piece, which is in the south of the area. And so now we've got 30,000 acres of land position in mostly patented private land. But as you indicated, we've also got state and federal lands in this package. It's a big land position. And we did that because it was a unique opportunity in a private company, a large gold system. It's similar situation with brownfield site. We've got a power line, we've got a water access, and we've got roads to site, and all this history of data that we can reuse. But more important than all of that was the fit in the sequencing with our Bear-Track Arnett project. Bear-Track Arnett's going to be 3.5, 4 years before we can turn a shovel to start construction. Our engineering team had already developed up the engineering plans and have handed it over to permitting preparations. So we were looking for another project to fit into the pipeline that could that our engineering team could take forward and that would permit faster than bare track garnet, and that's what we got with Mercur. We also got the same kind of exploration potential that we see at bare track garnet, and that's important to our exploration team. So if you think about the pipeline, Mercur's first on the list. It's a little bit further behind on the engineering side, but we're ramping up quickly there. Because it's on private land, we'll be able to permit that project in less than 3 years, and that'll give us the opportunity to move to free cash flow. We'll use that free cash flow to move the second project into production, and it'll be synergistic in the sense that our construction team will come off the one project and move on to the next one. While all that's going on, we'll continue to explore when it makes sense. When it makes sense to issue shares and take in capital to exploration, we've got a ton of exploration potential. Both at our Mercur project, I've mentioned it's a Carlin-type system. These are the most prolific systems in Nevada, but also at our bare track garnet system, which is an orogenic gold deposit. It's been outlined over 5 kilometers of strike, and we've got another 5 kilometers of strike, which is open for exploration. So lots of that to come as we continue to build out the story. But to answer your question, these are synergistic assets. There's a great fit with our strategy, and we were rightly placed to make the purchase. And it was, in some senses, opportunistic. We took a little bit of risk along the way because when you buy a private company, of course, private company shareholders haven't been able to buy and sell their shares. And so, as soon as they get public company shares in exchange for their company, they hit the exits. And I think that's the answer to the question you're going to ask me. Why are we at a 52-week low? We've gone through a cleaning out of some of those legacy shareholders who were in the private company for a long, long time, had no liquidity, and hit the exits when we bought the asset. Does that change the value of the equation for us? Not at all. We're really excited about this asset and what we can deliver with it, and so we're working on that PEA and the release of the results coming in the next 3 months.
So loads to touch upon there, and hopefully we'll talk a little bit about the geology of the Carlin type of deposits as well, because they can get complex. But the second part of my first question here would also be the things that you're saying. Some of them are specific to your company. Some of the reasons why you bought it are specific to Revival. Others not so much. Some of the other reasons are kind of obvious, if you will, and that begs the question to me: why were you the only one to see that they were obvious? I mean, how come you bought this asset, and how was it that nobody wanted to buy it before you did?
So this is the beautiful thing about cyclical industries. The time to buy assets is when nobody else wants to buy them. And that's the time to also build them, by the way. You get the A team, you get the best and most competitive pricing. And if you do it in the low end of the cycle, if you construct an asset in the low end of the cycle, you've got lots of runway ahead of you because, of course, the cycle will change and you'll be in a position to produce gold, other metals, as the case may be, at the higher end of the cycle. So from a strategic point of view, as you can imagine, at a low point in the capital, interestingly enough, even though we've got record gold prices, and herein lies the opportunity for investors, I believe, we've got record gold prices, and yet these assets are trading at trough levels. We've never seen price to NAV, EVs to EBITDA, dollars per ounce, whatever the metrics you want to choose. We've never seen them so low. And so and of course the reason for that is I'm happy to address. But that being the case, it makes for some very, very interesting acquisition opportunities, especially in the exploration development space, because that is the most risky part of the market. And, as the case was with this private company, they just didn't have enough money to continue to progress their project. And so their alternatives were to take an offer from us to join in with our business, or to languish and try and raise money at an even lower price than we were able to to pay uh, from a public vehicle. So that leads me to the next thing, which is there's capital market synergies here, right? Because the market does not need another IPO or RTO of an exploration junior. And if we can use the brand and the investor base that we have at Revival Gold and fold in a well thought out strategic asset like Mercur, that's synergistic and it builds critical mass for us and allows us to continue to build a better mousetrap in this market.
Well, you mentioned the private company would then, or the private company after that joined you. But as far as I understand it, you were related already because one of your directors is or was the chairman of a private company that you bought the asset from. That's not typically on my preferred to see list in these kind of deals unless managed properly. How did you manage that conflict of interest in the process?
Yeah, so I take an 180-degree different view on it, Antonio,
Hmm.
which is if we're going to buy something that is as complex as an exploration development project in a new region, the best thing we can do is have trust and a trusted and interested party on the other side. So Wayne Hubert is the person you're speaking about. Wayne put his own money into putting Ensign together. He and I have a long history going back to the Meridian Gold days when I was an investment banker. And so I have a deep familiarity with Wayne and his integrity and the way he works and the type of people he surrounds him with, and also alignment on strategy. You can see there were some common pieces there. We take a similar approach in the business, working as efficiently as possible, maximizing money into the ground, being absolutely diligent and fair on all those points that can trip one up along the way. So that gave us and me in particular a lot of comfort that the work that Ensign Minerals, this private company we acquired, had done was good quality work. And of course, we're going to have areas of departure. And of course, we have independence in terms of the processes. Wayne Hubert was not part of the board decision on the Ensign side, and he was not part of the board decision on the Revival Gold side in the transaction. He stood down and out from both of those scenarios. And we brought in an independent outside third party to help us with valuation and to make sure we were getting the right transaction. And so all of those governance bases were covered. But from my point of view, it was extremely comforting and extremely valuable to have somebody on the other side of the table who I trust and who has integrity and who's done great work.
Hmm. So essentially, it comes down to Wayne didn't have an influence on your decision to buy it, despite being a director with this specific situation.
Correct.
Okay, fair. These are complex things that I don't think I fully understand, but I appreciate you explaining them to me that way. You're targeting PEA on Mercer.
Sorry, one other thing to say, Antonio. I should comment here. It was equally important that on the other side, Wayne was able to say, "Hey, these guys with this public company, they've just made us a not so pricey bid for our vehicle with shares, are worth getting into bed with because I know them and I think they do good work and they're quality guys and they're not just a fly-by-night public company." And so I think it works on both sides. I just want to make that point. This business is all about relationships and working with people who you can trust because so much of the data and the information is complex and difficult to sort out in the short period of time one has for due diligence.
Was there? Didn't someone try to? I'm not fully sure in the details here, but I think I remember seeing something around that deal that there was another party involved or someone else tried acquiring the asset before that. Again, I'm not sure, but was that did Wayne actually choose for you to acquire it? Like, how did that happen?
Yeah, I mean, it was good timing for us. Somebody else had, and a credible party had come along and tried to put it together as an RTO in late 23. fall 2023. And they failed because they couldn't raise the money to complete the transaction. And we were able to do that. So again, having a solid shareholder base and the credibility in the market was key to the success of the transaction. And we paid in the end less money, and frankly, the fact that Ensign had gone through a due diligence process and had the benefit of a second set of eyes on their project before we got to it was hugely beneficial to us. Because of course there's always things that people find along the way, and as it was, there was an issue with one of the surface areas that was used in the calculation of a resource at Mercur, and so that got sorted out. We got a more advantageous price, and we were able to put the financing together to complete the transaction. So a few things fell into line, but I'll tell you what, timing's everything. I think if we'd come along in the fall, we would have been competing against another party, and so our timing in terms of the market was very good. And look, we're really excited about what we've got with Mercur. It's a great fit for our team. We've got a lot more work to go here, another plus or minus 3 months until we get the results of that PEA out, and we'll see where we get to. But at this point, I'm very excited about our progress to date.
We say plus or minus 3 months. I would have expected it to be plus or minus 2 months. Are you thinking Q2 now, or are you still sticking behind Q1 2025 for the PEA?
Yeah, end of Q1. It is almost the end of January. I'm still in the Christmas holidays.
I wish I was
coming back. So yeah, just over 2 months.
Right. Well, what has to happen in the meantime is an interesting conversation for sure. But just before that, what I'm thinking about is now the right time for this type of work? I mean, you say we've already got gold in the ground. Market's not giving us value for finding more gold, but is the market going to give you value for having a PEA? I mean, PEA is notoriously the boring stage of the Lassonde curve. It's hard to get anyone to care about anything in that stage or give you more of a valuation than what you're getting right now. So why do you believe right now is the right time for doing that PEA work?
Well, I'll tell you why. I think this is a market that's looking at free cash flow generating capability of assets. I think this is a market that is not at the speculative end of things. It's not rewarding drill holes, ounces added to the portfolio. I think this is a market that wants to see those ounces translated into value. And so if we can double our NAV, our underlying net asset value, by taking the step of going through the engineering, doing the metallurgical test work, you've touched on that a couple of times, and I'm sure we'll get to it. But you take those steps to demonstrate that there's economics in the ounces that we find. I think that's a huge value unlocking step. And I can tell you, there's a lot of sophisticated parties that are sitting on the sidelines right now with respect to Revival Gold, but they're watching very closely. We have them in our data room. We're in discussions with them frequently on technical matters, and they're watching the progress as we take resources and convert them into NAV. And that process will continue as time goes on, as we add more ounces. And as we have more engineering works, we'll put more value to NAV. But in this first step, I think a doubling of our NAV, which is what we're targeting, is huge for us, and it's a big catalyst in terms of some of those guys sitting on the sidelines that are a lot more sophisticated than the typical retail investor. They spend a lot of time and effort understanding not just where the gold is being discovered, but where the money is going to be made.
Metallurgy is definitely top of mind when it comes down to that, because doubling the NIV again, it has to. Everything else still has to work, and hopefully we can touch upon locals, permits, environmental, and everything. But or actually environmental concerns, given that it's heap leaching. How would that work? And what are you expecting from the metallurgical work? What exactly have you done so far? Where do you really want to get the recoveries? Talk to me about met work here.
So the first thing is that in North America, we are super comfortable, super experienced, and super excited about heap leach projects. Heap leach processing of gold resources is not very complex. It's relatively low cost from a capital point of view. And of course, these are typically open pit mines. So the mining side of it is relatively straightforward as well. So first on the priority is heap leach ounces from our projects. At our Mercur project, it's all heap leachable resource. And so that's a big advantage for us in terms of the simplicity of the metallurgy. The first thing we did after we acquired the Mercur project in the spring was start column test work. That's metallurgical tests to determine the kinds of recovery we could get from this heap leach resource material. We put those results out in September. We got well over 80% on the 5 columns tested. That is a very high level of recovery from a half-inch crush, and it really set us up well to do the engineering and the economics around the deposit. The other thing we've done, and this is a detail, but it's a very important detail. At an early stage, we have remodeled the resource. That involved taking approximately 1,900 drill logs in paper format, putting them into the computer. Small plug for the mining industry here, but we're one of the earliest and biggest users of AI technology. And in the case of Revival Gold's work with these paper drill logs, we did use AI to help us put that into textual format and then into the three-dimensional models for the geology. So with a refined geological model and with those column leach tests works, we were able to do not only gold distribution modeling, but recovery distribution modeling. So it's one thing to have the gold in the ground. We've got to get it out of the ground by mining, and then we've got to get the gold out of the rock by processing. So we've ticked off 2 of those boxes in the modeling effort, and now the team can work on the optimization of the mining plan for the third piece of that. So that's the approach we've taken at Mercur. Again, very important to tick that box on the metallurgy first and foremost, and then move to the resource and how that impacts the optimization of the plan, and then the economics. At Bear Track Arnett, we've already done 3 phases of met test work. We have heap leach resource there as well, and that's what our first phase is focused on, because again, it's low capital. It's relatively simplistic. It's exactly what they were doing previously when the Bear Track mine successfully produced. In fact, was the largest past producing gold mine in the state of Idaho. And so we don't want to reinvent the wheel there. Now, beyond that, and the opportunity that really got our geologists excited is the potential to go underground and into the fresh rock sulphide material at Bear Track Arnett. Again, it required us to do drilling and develop up resource, but it also required that we do metallurgical test work. And so we've done, as I mentioned earlier, 3 phases of metallurgical test work. We get a 94% recovery from 93% recovery from a pretty standard mill to create a concentrate, oxidization, and to create a residue, leach of the residue to produce doré gold process. And more interestingly than that, for us, is the prospect of stopping the process at the point where we produce a concentrate and selling that concentrate with the gold in it, and saving ourselves capital. So we've got both of those options. We've completed metallurgical test work that says We've got a really nice concentrate we can produce from our rock if we want to go in that direction. But ticking those boxes on the metallurgy was key. And that's what's so exciting to us about the second phase at Bear Track Arnett is the big potential beneath the heap leach deposit.
I want to talk about Mercur. Go back to the first couple of things that you said about Mercur, because it's you want to heap leach the oxides and the sulfides. What percentage of the resource do you think, once you're into PEA, and I understand this is forward looking and you probably cannot be exactly specific, what percentage is going to be sulfides? What percentage is oxides?
It's the material is 100% heap leachable. So, but in terms of the material that will go into the mine plan, I mean, we'll have yet to see that. Again, our targets for this are something in the order of 80,000 ounces a year from something in the order of a 10-year mine life, and a capital cost which would come in somewhere below 200 million for Mercur. So those are the objectives. We have more, absolutely a lot more exploration potential. But we think if we can hit those objectives with the PEA, it's something worth taking forward in permitting, and we can develop out future phases, as we'll do at Bear Track Arnett, and move expeditiously towards free cash flow. But you mentioned sulfides. These Carlin-type deposits tend to have carbonaceous ores, sulfide ores, and heap leachable ores in them. Our focus and the current resource is entirely on that latter category, the heap leach component. But there has been gold produced from those other two types of ore. There's a CIL plant and a POX plant at Mercur in the past, and who knows, maybe we'll explore those possibilities for future production as well. But our focus at the moment is on the heap leach.
Well, why I'm asking about specifically the sulfide content is because it's Carlin type, right? So I'm thinking about elevated arsenic, antimony, mercury, and or other deleterious elements, and how you might want to deal with those. It also depends. Well, it also matters to me how consistent the sulfide contents are across the ore body. But again, really strictly thinking about arsenic levels. I know you've reported, or maybe I'm mistaken, but talking about arsenic, antimony, mercury, other deleterious elements, and how you're going to deal with those.
Yeah, not an issue at Mercur. It's relatively clean material, and again, this is one of the reasons why it's so important to have the experience of the past operation. There has been heap leach gold production at Mercur in the past. It's been successfully done. There is no one of the other advantages is there's not a lot of water at Mercur, so we don't have a big issue around water or any of these deleterious elements at Mercur. Again, I want to emphasize this is a heap leach operation. We are not in the resource that we currently have at Mercur. We're not. We don't have any sulfide material. We do have carbonaceous material. Carbonaceous material is more complex because it requires a mill to produce gold, but it's not impacting our heap leach plans, and is actually a future potential opportunity for us if we can find enough of that carbonaceous material and rebuild a CIL plant on site. That could be an interesting future phase of operation.
Right.
At Bear Track, we do have arsenic and we do have mercury. But again, I point to the fact that the site has been effectively managed over 30, 40 years. We have treatment of water coming off the site, which gives us a huge benefit in terms of moving things forward. Usually, one of the things you have to do when you start a new mine on a greenfield site is you first, you establish a power line into site, you establish a road into site, and then you have to establish a management of water around the site. We've already got that in place, and we've already got the plant in place. It's a microfiltration plant that treats the water coming off the site. So if there's any naturally occurring heavy metals They get picked up in the plant, and we've got a long record of discharge responsibly from the site. So that technology, that approach, and that site infrastructure is already established for us, and won't be an issue for us going forward. As we get into the deeper sulphides at Bear Track Garnet, we do, as part of our metallurgical planning, we do take note of other metals. Interestingly enough, both Bear Track and Mercur are 100% gold. So small sidebar here, but for investors looking for gold, those 6.2 million ounces I keep referring to are 100% gold. This is not a copper equivalent or a silver equivalent situation. It's 100% gold. And to the extent there are any heavy metals or minor silver, we may make some revenue out of those, but the chemistry around that, we don't think it's going to be problematic. We will be able to produce very importantly, we will be able to produce a concentrate from the site, which has a high sulfide content, sulfide sulfur content, which is important because I'm getting into the details here, but when we sell our concentrate to an end user, those end users, as much as they want the gold, the precious metals, they also want the fuel that comes from the sulfur, and that is important to the reaction in the oxidization plant for the production of the metal. So we have some advantages around this concentrate. We do have deleterious elements, but the level of deleterious elements relative to the amount of gold we can concentrate is quite favorable.
So I assume by what you're telling me here, but correct me if I'm wrong, that there are no historical environmental issues, residual cyanide, heavy metal contamination, poorly reclaimed waste rock, stuff like that. There's none of those historic challenges, or are there?
Correct. You're correct. Excellent track record, state and federal rewards for not just for operation, but for reclamation of the site. And so there again, our predecessor operators have proven that we not only can we mine successfully, but we can reclaim successfully. And it's a wonderful site, Antonio. I'd love to get you out there someday to look at the site. But it's a real example of how mining can be done successfully, and how the temporal use of land for mining can be successfully implemented. And by that I mean we are not the end use of the land. Our job is to come in, make the most of the resource that is on that land, and in the case of federally owned public land, that is a public asset. So it's for the benefit of the public that we can go in, mine that, generate all the economic activity that comes from successfully mining that resource, and then return it to a natural state for use in some other manner, whether that's for hiking or dirt bike driving or hunting, or just going out and enjoying the natural environment. And one can do all of that on the Bear Track site in the areas that have been previously reclaimed. So we've got an excellent track record. I took a long-winded answer to your question. We have an excellent track record, and we've got proof of concept for the future operation.
Where I'm coming from with this is again because it is Carlin type, right? So it's oftentimes it's ultra fine, so we're talking micron to submicron scale, which in the past would oftentimes mean just using a bunch of cyanide, sometimes too much, and resulting in other challenges. But in your case, what I'm thinking, and that might also be a good point, is that it could result in lower effective recovery, so lower than maybe what you had hoped, unless you pre-treated, so fine crushing or something like that. Is that something that you think you're going to have to do here? And how confident are you in the preliminary met work actually working at scale?
I'll answer your last question first. We are very confident, and we base that confidence on that both these sites have produced gold successfully from heap leach in the past. Both these sites, we've now completed a column leach test to confirm, update, validate recoveries in the modern sense on material which would be produced in the future. So our confidence is based in science and experience, and so we're feeling very good about that. The second point, both of these projects, by definition, will involve the use of cyanide. Heap leach, production of gold from a heap leach operation utilizes cyanide to draw the gold out of the rock and then place that gold into an ADR recovery circuit so that doré gold may be produced on site. And then that cyanide gets reused in the process. This is very conventional, and these kinds of operations have a very good track record in the past. Cyanide is a toxic agent, but it's one that can be well managed. And in any industrial process, we have to take care with the environment, not least of which mining. The important point here is that we've got a track record of doing it successfully before on both these sites. And not only we have the track record, but we have the actual individuals involved. So our general manager is the former general manager of the Bear Track site. So when it comes to understanding how to operate, what kind of equipment, what kind of processes, what kind of safety and environmental techniques we can employ, we have the people that have done it before.
You have the people that have done it before on the company level, but it is also making me think about the people who might have lived close to site before, thinking about the locals. What is that looking for you? You say you have a good track record, so I don't expect them to be opposing, but have you spoken to them? What's the situation with the locals?
Yeah, in the case of Bear Track Arnett, we do pretty much an annual community open house. And the interesting thing there is that the first question I usually get is how's the exploration going? And the second question I get is, when are you going to restart the mine? And the third question is, where do I sign up for a job? This is, Lemhi County, where we are in Idaho, is a ranching, forestry area, and so the people understand where jobs come from, and they look forward to the potential restart of the Bear Track mine as an opportunity for employment and economic activity. We've got two mines in our area. One is the Idaho Cobalt Project, not far from us, which has had some fits and starts, and so community really like to see us move forward. And then we've got the Thompson molybdenum operation that Centerra runs, which is in a restart mode, currently doing a pushback there. So lots of experience with mining in our area, lots of comfort around it, and lots of interest in the jobs that can come from it. At Mercur, again, the situation is that we're in a part of Utah. Although we're close to Salt Lake City, we're on the other side of the mountains. We're just on the other side of the big Bingham Canyon mine, which is operated by Rio Tinto, biggest copper gold producer in the United States. So lots of mining talent in the area, lots of understanding of how mining can be beneficial to the communities. And our initial discussions with the Tuala County municipality and with the state Dogum officials have been very constructive, very welcoming. We've had the Utah Geological Survey out looking at our rocks and collaborating with our exploration team, and there's a lot of enthusiasm and excitement about this. So I would say thumbs up in both Utah and Idaho for responsible mining, and thumbs up from local interests in these projects.
what other permits do you have to get in that case for Utah? Because that's where you're moving toward production quicker, as you told me. What has to happen in the meantime? Is there anything that could be challenging or anything that you're already working on?
Yeah, we are underway with developing a detailed permitting schedule for that project, along with the PEA, preliminary economic assessment. So we'll have more to say about those, Antonio, in just over 2 months' time uh, when we put out the PEA results. But my expectation is that we'll be able to move through the state-run process. The entity is known as DOGMA, Department of Oil, Gas, and Mining, and the Utah state government. In Utah, the state coordinates the permitting activities, so all the state agencies and the federal agencies that may be involved are coordinated by the state. And we're looking at the possibility of an EA process, which we can complete in less than 3 years. So we'll have more to say about the details of it, but that's our expectation at this point in time.
Hmm. Would you guess it's reasonable to be taken out somewhere along that process, though? I mean, having to go it alone, and I don't know what the scale is going to be. You said you're targeting a doubling of the NIV. Still, maybe not as obvious as it would be for this to be part of another larger operation, if that makes sense. Would you expect that it's reasonable to be taken out somewhere along that process?
Look, we're already at 6.2 million ounces of resource. We're targeting 150,000 ounces a year of production. And anything near, where we're seeing heap leach gold assets produced today, we could be, upwards of 70, $80 million a year of free cash flow from these two operations. So that's a big business. And it's an attractive business because it's located in the Western United States. I can't emphasize that enough. There's a lot of appetite from lenders and from investors for low risk in the United States relative to what we see going on elsewhere in the world today. So yes, I think there'll be a lot of interest. Are we going to want to sell? I don't know. I think we'll cross that bridge when we get to it. What I'm focused on is surfacing the value and making sure that we don't have to depend on a takeover as our only alternative to delivering maximum value to our shareholders. Does that mean we're not looking at the possibilities of mergers of equals or acquisitions or these takeover opportunities? We have to look at everything. That's where I focused pretty well most of my career in the gold business, on growth, on strategic development, and so we have to look at all of those kinds of opportunities. But the path forward is to give ourselves the option of moving forward independently without having to rely on a big brother. That's how we create tension in the process, frankly, and it's how we get ourselves to maximum value for our shareholders. So we don't spend any time looking in the rearview mirror. We're pushing ahead, moving these projects forward, and as diligently as possible in a very tough market.
Is that true for both Idaho and Utah, for both of your projects there?
Yes, that's true. I think the first one in line is Mercur, and if the results come out next 2 to 3 months on our Mercur project the way we expect, we're going to want to make that the lead charge, and we're going to want to put our efforts first and foremost into that. We've still got a ton of exploration potential at Bear Track Arnett. And of course, it's going to be longer on the permitting timeline, so we'll have time to do that exploration. But as I think about the waterfall of where we want to spend money going forward, let's see this PEA come out. But my expectation is that we're going to want to put our emphasis on that first, our exploration at Bear Track Arnett, and continuing of the permitting of Bear Track Arnett as the next steps after that.
I would also assume that a big part would be metallurgy work at Bear Track Arnett, because and this might actually be a question. If the metallurgy proves more challenging than you would ideally want it to be, do you think the project could move forward as just a heap leach operation without being able to process the sulfides economically or effectively at these prices?
Well, I'm going to answer the first question first, which is we don't have a problem with the processing of the sulfides. We've proven that with 3 phases of metallurgical test work. Folks that are interested in that can, of course, go to the technical report on Bear-Track Arnett, where we cover that off extensively. But we have 2 options with respect to those sulfides. One is to fully process them and produce doré gold on site. The second is to produce a concentrate and sell the concentrate to an end buyer. It's really interesting to me that the Stibnite project neighboring us, owned by Perpetua Resources, has now got their record of decision and are moving forward with their plans to develop out a plant there. We have a very similar material to what they have, and so there's some real benefits to us in having their project progress. And as we move the second phase of our project forward, there's a potential home for our concentrates in that future operation as another alternative. But what I wanted to say and leave you with, Antonio, is that we've completed the metallurgical test work. We're feeling really good about the recovery of the sulfides at Bear-Track Arnett and what that could be in terms of value. And the deposit is open. So we want to do more drilling to continue to grow that resource and then put that second phase project into an economic plan. In the meantime, to answer your second question, the priority is the first phase heap leach for us because it's low capital. It's a high return project, 34% IRR. At $2,000 gold, so that's a really impressive situation, and it does not depend on the sulfides. It's a strictly standalone first phase operation. Now, we want to dream in Technicolor, as some of our bigger peers might like to do. You're looking at a 4.6 million ounce resource that's only been explored on half the structure. Of course, you are looking at the possibility of a combined heap leach, sulfide, or single mill processing option. That's a bigger capital item, and that's a bigger company's job. But I'm sure there's some folks who've been running numbers on those scenarios, but we'll leave that with them. Our focus is a phased approach: heap leach first, sulfides underground second.
And it is that report that I was looking at that kind of birthed that question. It's point 13.1 where the report talks about the historic test work that's been done on the project, saying that it is essentially the recovery was approximately 60% for the samples that they tested without pre-oxidation. So that's why I was referring to economics, and if it doesn't work the way you expect it to at scale.
So I just want to. So you're mixing apples and oranges. The material in the heap leach project is dealt with as a heap leach with an average recovery in that overall plan of 62%. So there is no excessive assumptions in there. Historically, the operation produced over 70%. We used the more conservative assumption from our test work. And again, that project generates a 34% IRR. The material in the sulfide metallurgical scenario, for the mill scenario, for the material that will be milled in the second phase, that will require a pre-oxidization step, which is designed into the flow sheet, which is also in the technical report, and designed into the underlying costs from a first principles when we produce the resource there. So they're 2 different things. One's a heap leach operation. The other is a sulfide mill operation. and both of them have flow sheets that have been developed up from first principles, and both of them work, and both of them are underpin the economics for the resource, which is covered in the report.
Right. And it is,
So there is
yes.
no risk around our metallurgy on Bear Track Arnett. We've used the assumptions from the test work we have for the first phase heap leach with an average 62% recovery. And on the mill side, we have a 93% recovery from the full flow sheet on the mill side. I can go into the details of that flow sheet, but that is all reflected in the flow sheet we're using. We are not just cyaniding the material for the mill side. We have a concentrate step, we have a pressure ox step, and we have a cyanidation step.
Yeah, and that is exactly, I understand that part, and that's exactly where I came from with the first question, which was, does it work without those other ones? And that's what you explained earlier. Good. Is what is happening there in 2025? What's happening at Bear Track or Net in 2025? Or is it currently completely financing and kind of financing dependent and kind of on a back burner, if you will?
It's not on the back burner. We're working through permitting preparations. We spent 2024 developing up a draft plan of operations. We're working on the gap analysis for the steps with respect to permitting, what's going to be required. We want to see how the PEA comes out on Mercur as to which permitting we want to push the button on first. And so all of that's kind of coming together over the next 2-3 months here. We have also, in 2024, we completed a lot of work on developing out the business case for further exploration. We have a number of discussions going on with parties around that exploration and what we might do in the field season this year in terms of drilling. We're not currently financed to do that work, and we want to be, as I mentioned earlier, careful about that trade-off between issuing equity and doing drilling. If the drilling, even though successful, isn't going to be rewarded in the market. But we've developed up the business case, and we're engaged in discussions around those exploration targets with strategic and financial partners with respect to those opportunities. And in the meantime, our focus is on the PEA at Mercur. You haven't asked me yet, but cash balance at the end of the year was about $1 million. We do have sufficient capital to get through our PEA plans here, but we are also looking at funding for 2025 and what we might do next. So we're in the middle of a lot of discussions around that and looking at optimization around funding packages and timing of the PEA and how that kind of impacts our longer term plans.
I know you have to go here, Hugh, but just on the financing, that would have been my next and final topic here. How do you see that happening? Because you don't want to wait too long where everyone knows that you don't have a way out, but you also don't want to do it when you're at an all-time low. Maybe you want to come up with the PA first and have a better share price by the time you do a financing. Talk to me strategically. Who do you raise with? How much do you have to raise? How do you raise it?
Yeah, so as you can bet, it's top of mind right now, for sure. So we're going through all of those thought processes, considering all of our options, and working on plans. It would be a bit premature for me to tell you where we're going to land here, but we've got a lot of exciting things going on. We've got some really supportive shareholders in the company. We do have sellers in the market, as everybody does, so we have to deal with some of that. But in the long term, we've built a great business. We've got 2 great assets, and I don't think anything we do in the short term, will impair the longer term ability to deliver value for our shareholders, and so that's where we're focused. I don't expect to be doing anything here now that will get in the way of my wife's $3 share target for me on the home front. That's important.
Maybe one day we should talk about what your wife thought of your cycling career, because I've got a little bit of experience with my wife and her thoughts about that. Let's
Well, suffice to say, I'm back to work, so she didn't think much of that.
That's clear, and hopefully this one works out better. There's, I suppose, there's more things to get to. Let's do it another time. I know you have to run now, but what else did you come here? Excuse me, hoping to talk about that I failed to bring up?
You've brought up an awful lot, and I enjoy this long form interview, Antonio. I'd love to do more of this with you. Love to get you out to site, and
Thank you.
in this business, I can tell you from experience that there is no overnight success. It's usually a much longer, 7, 8, 9 years before all of a sudden market wakes up and sees an opportunity. And so, what I would say is that there's been a lot of really good work, $80 million of investment, and some excellent results out of the team and the assets to date. Anybody buying shares today is getting a steal.
Thank you so much, Hugh, for your time today, and hopefully speak again soon.
Thank you.
And thanks to everyone for watching the CEO Barbecue. I have a couple of more things to say before we go, though. The fact that this company was interviewed in here does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone, but simply to ask a few questions. If you find that I failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview by asking those specific questions. As mentioned at the beginning, please understand that mineral exploration development is an extremely risky business, and losing money is the norm and should be the expectation here. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, marketing ability, and many others, as well as other moving particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more. Again, it's very complicated and it's not for everyone. Moreover, these companies are typically in the pre-revenue stage, which means they rely on the public markets for the financing of their operations, which will sooner or later result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation, their presence on social media, or even the social media accounts which you thought were your friends and told you about the stock, and really everything that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of this business, many out there might, and you should be aware of the inherent bias related to that. It is safer for you anytime you're watching or consuming any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased, because there will always be at least some sort of a bias, again, albeit clear off the get-go or not. So always ask yourself, what is the incentive of your counterparty, and never rely on them regardless of their incentives, but instead double check if what they're saying is true or not by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I don't have a long enough track record of consistent investment profits, so I should, under no circumstances, be considered an authority on anything, and you should not care about my opinion. Although this might sound amusing to you, it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, as at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know what's going to go up, what's going to go down, or what's going to go in circles. And none of us really know whether any of the company's activities will result in a success. Again, given that we're talking about high-risk activities here, where most of the times it ends in failure. Also, unfortunately, try as I may, I'm not always going to catch all red flags or all challenges with the company. So even if I did ask a few tough questions, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving particles, and I am not always going to be able to catch all red flags. And on top of that, again, I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this content. Viewers, listeners, and readers acknowledge and agree that the information presented does not constitute a solicitation of an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks, or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties and everyone involved in the management of the business from all claims, proceedings, or consequences. This is all to say that you shouldn't blindly trust nor rely on me or anybody on the internet, and you should do your own research as well as talk to a licensed professional investment advisor. Once again, social media is meant for entertainment. Setterplus.ca is where you do your research. That's where you find the company's official filings, and I encourage you to read and analyze all of the official filings that you can find, with examples being the management information circular, the financial statements, the management discussion and analysis, and whenever available, the NI 43-101 technical disclosures. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts and the best investors in this sector losing money are already extremely high, since this is venture capital. And again, it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."